Welcome to this explainer. Today, we're diving deep into the core engine of corporate capital, business finance. And look, we're skipping all the confusing jargon and those intimidating spreadsheets. We're just going to look at the clear, undeniable mechanics of how businesses actually work, and more importantly, how they survive. We'll break it all down into some really simple structural truths. So whether you're dreaming of starting your own company or you just kind of want to understand the mechanics behind the businesses you interact with every single day, this explainer is designed to give you exactly that foundation. You know, a company can have absolutely world-class products. They can have incredibly happy customers, literally singing their praises, and they can even have really strong sales. But here's the stark reality. If the money isn't managed correctly, the business can and usually will collapse. Great ideas just don't guarantee survival. Financial literacy does. It sounds a little daunting at first, but as you'll see, the basics are actually incredibly straightforward. Okay, let's dive into this. Part 1, the basics of survival. This is the core engine of any business. The absolute first thing every single business needs to understand is revenue. Revenue is the top line. It's simply the total money a business receives directly from selling its products or services. And this is before anything else is considered. It's literally the very first step in the entire financial process, money coming in. Let's anchor this with a really simple, everyday example. Imagine your favorite local coffee shop. Let's say today they sell exactly 100 coffees, and they charge $5 for each one. 100 times 5 equals a neat $500. So that $500 is their revenue for the day. But I want to stress something absolutely crucial right here. Revenue is not the same as profit. No way. A business can generate a massive amount of revenue and actually still end up losing money. Why? Well, because of what comes next. Every business has costs, right? And these are called expenses. These are the things that actively drain that revenue we just talked about. We're looking at things like the rent for the building, salaries for the employees, the equipment like those super expensive espresso machines, plus marketing materials to get people in the door, and even the software used to run the cash register. If that coffee shop earns $10,000 in a month, but spends $9,000 on all these things, they only have $1,000 left. Managing these costs is how businesses actually control their money. So that brings us to the most fundamental formula in all of business. Let's walk through it step by step. Step 1, you take your revenue. Step 2, you subtract your expenses. Step 3, that equals your profit. Profit is just what remains after paying all those costs we just listed. It's the actual tangible reward you get to keep for taking on the immense risk of running the business in the first place. Let's look at a profitable scenario just to make this super concrete. Say a business earns $20,000 in revenue over a certain period. Their total expenses for rent, supplies, and salaries add up to $15,000. Following our simple formula, that leaves a profit of $5,000. That right there is a successful cycle. But just when you think you have it all figured out, business finance throws a major curveball.
Which brings us to part 2, the true business lifeline. It's time to talk about cash flow.
Now, what's really interesting here is separating the two concepts beginners confuse the most. There is a massive and honestly dangerous difference between earning a profit and actually having cash. Profit, as we just calculated, often only exists on a piece of paper. Cash flow, on the other hand, is what's actually sitting in the bank account. A company might make a profit on paper, but if their customers take 3 whole months to actually pay their invoices, well, that business has zero cash today to pay its own bills. Cash flow is the literal movement of money entering and leaving a business. And I want to be really clear about this. Mismanaging this exact flow of money is the number one reason seemingly successful, profitable businesses suddenly collapse. They don't fail because they aren't profitable. They fail because the timing of the money coming in doesn't match the timing of the money going out, and they simply cannot manage the cash. Cash flow is the true lifeline. Let's zoom out a bit. Part 3, building and borrowing. We're looking at the long-term structural pieces of our business machine now. This all starts with assets. Assets are clearly defined as things a business owns that have value. Think of them as the foundational pieces. Strong businesses build up their assets because these are the exact tools that help the business generate more money in the future. So, what does an asset actually look like? Well, it's the equipment they use. It's the property they own. It's their proprietary technology, or even the inventory just sitting in the back room waiting to be sold. But it's also intangible things, like brand reputation. Think back to our coffee shop.
Their high-end espresso machines, those are assets. But their local brand name, the whole reason there's a line out the door every single morning, that is also a massive asset that creates true value. Now, right in contrast to assets, we have liabilities. If assets are what you own, liabilities are your financial responsibilities. Simply put, it's the money you owe to others. These are your financial obligations that must be carefully managed. Examples of liabilities would include bank loans, overall business debt, and unpaid bills to suppliers. Now, it's absolutely crucial to point out that while the word debt often sounds really scary, borrowing money is actually often a completely necessary tool for a business to grow. Debt isn't always a bad thing. The problem only starts when that debt becomes impossible to manage alongside your cash flow. And this leads us directly to the concept of investment. You see, businesses often need to spend money before they can make more money. Smart businesses take their capital, whether it's profit they've saved up or money they've borrowed as a liability, and they inject it back into the machine. They spend money right now on better products, better employees, advertising, or new technology, specifically to create future growth. Basically, they're building a stronger, faster machine. Let's move on and see how this builds. Part 4, optimizing profit. Fine-tuning the machine for maximum efficiency. A really great business doesn't just ask, hey, how much money did we make? It asks, how much do we actually get to keep? And that is your profit margin. It's the percentage of profit that remains from your sales after all your costs are handled. The larger that slice of profit kept, the higher your margin. And a higher margin usually means you're running a much more efficient business. The real question is always the size of your slice. This highlights a common trap that beginners fall into, the myth that simply selling more equals making more money. But think about it. If your price is too low, you might sell a ton of product. You might literally have a line around the block for your coffee. But because your costs are fixed, you could completely destroy your profit margin in the process. Successful businesses understand the delicate, necessary balance between the price they charge, the cost to make the product, and the value the customer receives. Part 5, the real goal. Distilling it all down to long-term survival. So the crucial point here is that the ultimate goal of a business isn't just a quick payout or making one single impressive sale. The real goal is making money consistently. It's about keeping enough actual cash on hand to weather the unexpected storms. It's about meticulously managing your costs. Ultimately, the goal is building a healthy system that survives long-term. Behind all the intimidating corporate jargon, behind the complicated spreadsheets and the fancy boardrooms, business finance always boils down to this incredibly simple, undeniable math. Money comes in, money goes out. The difference between those two movements determines success. The better you understand these basic mechanics, the better you can understand how the commercial world around you actually operates. I'll leave you with this final provocative thought as you look at the businesses in your own community, or perhaps plan one of your own. Are you just trying to make a quick buck today, or are you actually managing your cash, your margins, and your assets to build something that survives